So the question on the table here is, if we are concerned with current price action, why do we need a look back? The look back is not a lack of concern for current price action, or what's known as a hard right edge. The look back is putting the proper perspective on your chart. The look back is about having a certain amount of data in front of you. Without the look back, my experience has been traders will just very randomly put any amount of data on their screen because they're never taught to consider a certain amount of data. Some will put too much, some will put too little. The reason I go with a look back is I know whenever I'm looking at a 60-minute chart, I'm looking at 2 weeks of data, and I believe 2 weeks is the relevant amount of data needed to make decisions about near-term highs and lows, to make decisions about significant rallies and declines, to make decisions about, of course, the actual angle of the 34-period EMA. Because remember, if I take this at a look back, what am I looking at? Sure, I can look at the hard right edge. Anybody can do that, right? But now, what am I missing out on? Last major move, significant highs and lows, the rallies, the sell-offs. It's not just about the last handful of candles. To me, it's about how do we get here. Now, I think there is such a thing as too much. Obviously, I do think there's such a thing as too much data. But I think, again, what's just right is the settings that I've shared with you for each one of the time frames. Obviously, 2 weeks would be overkill for a 15-minute chart. I don't believe the memory of a 15-minute chart goes much more than about 3 to 5 days. At the same time, to have only 2 weeks on, say, a 240-minute chart, I'd be missing out on some of the important price action. So it's about the important price action that led up to where we are right now on the hard right edge. So if you're wondering why the look back, because I admit, it can be kind of uncomfortable because of the amount of data that you might be looking at in a small chart. But remember what you're focusing on. Near-term highs and lows, significant rallies and declines. If you're a Fibonacci fan, that's a perfect place to look for the last major moves. Obviously, we want to take the clock angle reading within that look back. Okay, those are just some of the things we want to look. By the way, the touch points even, these highs and lows, the touch points will make an impact as to what kind of price patterns that we might actually be drawing or what kind of trend lines we might actually be seeing. Okay, if you have very little data, your touch points are limited. When your touch points are limited, you may not see some of the larger patterns and some of the longer uptrend lines and downtrend lines and some of the more important support and resistance levels. Okay? Look back to this area right here. Let's go to the look back again here on this chart. Okay? Take a look at this high right here and where we are right now. I'm just going to grab the horizontal line tool. If I didn't have look back in here, I might miss something like this. All right? So again, the look back is relevant because past price action, I think, does leave certain clues, like breadcrumbs. All right? Okay, so let's talk about setting up this particular swing trade because we want to talk about trade and risk management here today. So how do we set up a swing trade? Rule number one, the first rule, the first step is identify the uptrend or downtrend. And I'll admit, this is just for example purposes, but this may not be the best downtrend I've ever seen in terms of the 4 to 6 o'clock angle. It's certainly not awe-inspiring, okay? But it's something I could focus in on. We'll look at some other examples on some other charts, but just from the mechanics of it, okay? Again, realize that this is not a superb angle, but again, just the mechanics of what we want to do here. So identify the 4 to 6 o'clock. That's number one. What's number two? Well, I want to go ahead and determine what that correction or that swing will be. Now, because I've already made determinations about near-term highs and lows and things of that nature, at that point, you can feel free to get out of the look back. I mean, if you need to expand it to do some of your analysis, feel free at that point. You don't need to remain in that view. You're not handcuffed by the actual market memory or look back. I don't want you to feel that. You can absolutely expand out of it once you've made that clock angle reading and those other determinations we just talked about, those other decisions. So one of the things that I might examine would be the possibility for Fibonacci to be a reasonable correction. Okay, that might be one decision. I might look at pivots as a potential for identifying support and resistance. Okay, probably one of the easiest for sure, and I also say one of the more effective ways of doing it is to actually use the wave itself. So I've used the wave to determine what the angle of the of the market is, and then now I also want to go ahead and possibly use the dynamic support and resistance that it offers to shed light on where I might find a short entry. Now it's a short entry because it's a downtrend. I'm looking to follow the overall trend here of this current market. Again, this is a 60-minute chart. You know, the daily might be doing something different. The 15 might be doing something different. We're focusing in on the psychology of this particular time frame. And on this particular time frame, for now, based upon the wave, we've got weakness. And if we've got weakness, I want to short into the correction, the bounce. And that means that as prices will begin to rally, I want to narrow down what levels prices might find resistance at. So that resistance might be found, like I said, via Fibonacci, pivot points, psychological levels, or the wave itself. Now, realize that, and I'm just going to use the hard right edge here to kind of make a point, realize that when the prices are looking like this, oftentimes it's going to feel like, wow, are prices ever going to correct up to the wave? I mean, look at the distance. Sure, the market's heading down lower, the wave is confirming the markdown cycle, but are prices ever going to catch up to the wave? You'd be amazed how often they do. And if it's not the wave, it might be a 38.2 or a 50% Fibo. It might be a psychological level. Okay? So focusing in on the 34-period exponential moving average on the low, what you'll find is every hour there might be a slightly different reading of this bottom moving average. So that means that if you are going to use a limit order, you're going to have to keep an eye on what the 34 exponential moving average on the low is actually plotting at, because that's going to be your limit order to sell. So you can see right here, and I'll blow this up even a little bit more, you can see right here prices pierced the resistance of the wave. You can see that right there. The moving average was sitting at 35.81. By the way, that's 35.80 is a minor psychological level. So I love the fact that I've got my 34-period exponential moving average on the low overlapping with my 35.80 psychological level, minor psychological level. Remember I said you could use Fibonacci, you could use psychological levels, you could use pivots. My preference, and in order of my preference, is the wave, psychological levels, and Fibonacci. I typically don't use pivots unless I'm trading very short-term intraday time frames, like a 5-minute, maybe a 15, or if there is not a valid last major move that I could use for Fibonacci. So usually what pivots become for me is the fact that I'm going to be using that if there is not a good Fibonacci available, a good last major move Fibonacci pull available to me. So again, I'm going to be focusing on the wave, psychological levels, and Fibonacci. And notice the 38.2 right here was overlapping with not only the wave, but also that minor cycle level. So there's a lot of reason to think this 38.2 is going to be a strong, formidable ceiling. By the way, why not the 23.6? My experience has been it's too shallow of a retracement. So I will very seldom use the 23.6 unless there is some other reason, like a psychological level, a double zero, some other reason why I believe the 23.6 will be stronger than the typical shallow, weak resistance it is, or support that it typically is. I'll usually look up to the 38.2. Okay?